Most investors think they're diversified. Thomas thought so too. 44 years old, software engineer, $340,000 invested over 11 years. And for every single one of those 11 years, he did exactly what the internet told him to do. Buy VOO, buy VTI, repeat. Sounds familiar, right? Every YouTube video says it. Every finance subreddit recommends it. Every expert portfolio seems to prove it works. It's basically the commandment of personal finance at this point. But here's the uncomfortable question nobody's asking. What if the safest strategy is the one silently costing you the most? It started with a random Tuesday lunch. A colleague, just casually between bites, mentioned an ETF Thomas had never heard of. Not a new crypto, not a risky stock. An ETF, something boring, something supposedly in Thomas's lane. That night, curiosity got the better of him. He opened the full list inside Vanguard. Not 2 funds, not 10, 113. And that's when it hit him. For 11 years, he wasn't choosing the best option. He was choosing from less than 2% of what actually existed. That's not a small oversight. That's like showing up to a buffet eating the same 2 things every visit for a decade and never once looking at the rest of the menu. That's the NPC loop right there. Wake up, buy VOO, feel responsible, repeat. No shade, I get it, I really do. That was the responsible move. That's what we were all told. But Thomas couldn't unsee what he'd just seen. So he did something most investors would never do. Because honestly, most investors are too comfortable or too scared, or both. He tested all of them. Same $10,000, same time periods. No bias, no guessing, just data. What came next doesn't just challenge the internet's favorite advice. It completely breaks it. The ETFs almost everyone blindly buys didn't even make the top 5. One unknown fund dominated both short-term momentum and long-term performance. And the gap? Massive. One turned $10,000 into $28,000 plus. Another barely moved. Same platform, same 5 years, same starting money. Only one difference: the decision. Today, I'm going to show you the exact data Thomas found, the 5-year backtest results, and the name of the one ETF that changed everything. Vanguard offers 113 ETFs, but not all of them qualify. Remove the ones without a full 5-year track record, and the list shrinks to 84. Each one tested the same way. 2 timeframes. 1 year to capture momentum, 5 years to expose consistency. Because here's the problem. 1 year can be misleading, a lucky run, a temporary trend. But 5 years, that includes everything. Rate hikes, crashes, recoveries, real conditions. Then each fund was placed into 7 categories: bonds, mid-cap, small cap, large cap, factor, dividend, sector. No opinions, no predictions, just results. Segment 1, bonds. This is where things start to break expectations, because bonds are supposed to be the safe part of a portfolio, stable, predictable, low risk. That's the theory. The reality looked very different. Across all 15 bond ETFs, the entire performance range was shockingly narrow. At the top, VTIP, $10,000 into $12,415. At the bottom, BND, Vanguard's most popular bond ETF, $10,000 into $10,185. That's it. That's the spread. 5 years and barely a difference worth celebrating. But here's what most investors missed. While these funds looked stable on paper, inflation was quietly eroding everything underneath. So in real terms, many bond investors weren't just standing still, they were losing ground, and they didn't even realize it. The answer isn't complicated, but it is overlooked. This period included the most aggressive rate hiking cycle in decades, and when rates rise, bond prices fall immediately. Now look at the structure. BND holds everything: short-term, long-term, mixed exposure. That sounds diversified, but in this environment, it diluted performance across the board. VTIP did the opposite. It focused on short-term, inflation-protected bonds. They matured faster, adjusted faster, and continuously rolled into higher yields. Same category, different structure, completely different outcome. Most investors think owning bonds is enough. It isn't. Because in a rising rate environment, what you own matters more than the fact that you own it. And then came the number, the one that forced Thomas to question everything he'd believed for 11 years. A single ETF turned $10,000 into $20,845. Large cap, 5 years. Sounds normal until you hear this. It wasn't VOO, it wasn't VTI. Segment 2, mid and small cap. This is where the pattern becomes impossible to ignore. Mid-cap leader, VOE, $10,000 to $17,300. Small-cap leader, VBR, $10,000 to $16,149. Now compare to the bottom, VTWG, same category, same time period, $10,000 to $11,215. That's nearly a $5,000 gap inside the same segment over the same 5 years. Not a different market, not a different strategy, just a different choice. And then the pattern revealed itself, not once, not twice, but across both segments. Value beat growth decisively. Most investors never connect this part. They just look at returns, but the driver was macro, rising interest rates. And rising rates do one thing very well. They punish growth, because growth companies rely on future earnings, money they haven't made yet. And as rates rise, those future earnings get discounted harder. Their valuations compress fast. Value companies, they already generate cash, real earnings right now. They don't depend on cheap money to justify their price. So while growth struggled to adjust, value kept compounding. But here's where it gets uncomfortable, because just as the pattern became obvious, it started to shift. In the most recent one-year window, growth came back hard across both mid and small caps. Why? Because the market shifted toward global value. The US dollar stabilized and international markets finally started closing the valuation gap. The real insight: US growth dominated the last decade, but right now in 2026, we are seeing a massive rotation into energy and international dividends. The cycle is flipping. But here's where most investors get it wrong. They chase what just worked. They look at 5-year returns, see value outperforming, and move in late, right as the cycle begins to turn. The investor buying value today because it dominated the last 5 years might not be early, might not be smart, might be doing the exact opposite, buying at the worst moment in the rotation. Segment 3, large cap. This is where expectations break completely. 5-year winner, MGC. $10,000 into $20,845. And here's the part that doesn't sit right at first. It wasn't VOO. It wasn't VTI. VOO finished 5th, $20,115. VTI fell even lower, $18,890. Why did MGC win? One word: concentration. MGC holds roughly 185 stocks, but it leans heavily into the biggest names in the world: Apple, Microsoft, Nvidia, Amazon, companies with massive cash flows, balance sheets that don't care about interest rates. They don't need cheap money, they generate money. And that concentration, it amplified returns. But here's the decision that matters. After seeing this, Thomas didn't switch. He kept VOO. Why? Because the difference was just $379 over 5 years, and almost all of it came from a handful of positions. The trade-offs most people ignore. When concentration works, it wins, but when it reverses, it unwinds just as fast. VOO sacrifices a small amount of upside for a massive reduction in concentration risk, and that trade, over decades, matters more. Outperformance is easy to admire, but understanding how it was generated, that's what protects you. Because chasing what just worked without understanding the structure behind it is how investors quietly take on risks they never intended. At this point, the rankings were already surprising, but what came next were the two most important results in the entire dataset. One ETF outperformed across both timeframes, the only one out of 84, and another turned $10,000 into $31,450, the highest return in the entire analysis. But the story behind that number is also the biggest warning in this entire video. Segment 4, dividend funds. This wasn't just surprising, it was unexpected. The winner? VYMI, International High Dividend ETF. 5 years, $10,000 into $21,110. 1 year, $14,500, a 45% return in 12 months. And here's what makes it different. It's the only fund in the entire analysis that won both timeframes, short-term, long-term, consistency, and momentum at the same time. It beat VOO, it beat VTI, it beat every large-cap ETF, and it didn't do it with US tech. No hypergrowth companies, just international businesses paying high dividends. What actually drove this? Two forces. First, international markets were undervalued, deeply compared to US stocks. When that gap started closing, capital moved fast. Second, the US dollar weakened, which means every foreign holding automatically increased in value. But here's the question that matters, and almost nobody asks it. How much of this is repeatable and how much of it already happened? Because the valuation gap, it's already narrowed. The dollar may not keep weakening the same way. You don't buy something because it ranked first. You buy it if the reason it won still exists. Segment 5, Factor and Sector. Now things get even more interesting because one fund quietly did something most investors overlook. VFMF, US Multi-Factor ETF. $10,000 into $20,150. It beat VOO using the same market, same stocks, just filtered differently. A fund almost nobody talks about, outperforming the one almost everybody owns. Now, the overall winner. VDE, Vanguard Energy ETF. $10,000 into $31,450. The gap to second place, over $10,000. Nothing else came close. Because this wasn't random, it was a cycle. COVID crushed oil. Energy became the most hated sector in the market. Institutions were exiting, retail ignored it. Then everything flipped. Demand surged, supply stayed tight. Oil crossed $100, and energy companies printed record profits. VDE didn't just perform, it captured the entire move, from maximum pessimism to maximum profitability. The investor buying VDE today is not making the same decision, not even close. That return came from buying when nobody wanted it, before the recovery, before the profits, before the attention. Buying now, though, that's different. That's buying after the story's obvious, after the move, after the reward. The truth most people miss. Chasing a 5-year winner is never the same as holding through the cycle that created it. After analyzing all 84 funds, one pattern stood above everything else. 5-year winners, US sector funds dominated. 1-year winners, international funds dominated. Example, VPL, $10,000 into $15,100 in 1 year, over 51% return, but over 5 years, just average. What this actually means: leadership rotates across sectors, across countries, across time, driven by interest rates, currencies, and valuations. And here's the uncomfortable truth. What's winning today is usually not what wins next. What Thomas actually changed. After all this work, he didn't rebuild everything, he refined it. 15% VYMI to capture international dividend exposure while the gap closes. 10% VFMF for systematic factor exposure on top of US core, and replaced BND with TIP to protect against inflation instead of pure rate risk. And his core, VOO and VTI, untouched, because the goal isn't to chase winners, it's to understand where they fit. The core gives stability, the additions give opportunity. Your challenge: open your portfolio right now. List every fund you own. Check the 5-year return for each. Then compare it to VOO. Ask one simple question: am I actually outperforming the simplest benchmark available? Because the investor who knows that answer makes better decisions every time. If this changed how you see your portfolio, subscribe. Next video, we build the optimal Vanguard portfolio using these exact insights. Real allocations, real structure, no guesswork. Thomas held 2 ETFs for 11 years. He wasn't wrong, he just didn't know what he was missing. Now he does. See you in the next one.